Well, we got a new guest on the show, Dave Seymour. Dave, thank you so much for being on the show. And why don't I just kick things off and have you introduce yourself?
Yeah, man. I appreciate you having me on, Jack. This is fun. My name is Dave Seymour. I got an opening line, Jack. You ready? You might recognize me as the star from the hit TV show Flipping Boston on A&E. Now
Yeah.
now we're on Amazon Prime. So yeah, I've been a real estate investor and been recognized nationally for my expertise in pretty much all areas of real estate, Jack. I've been very blessed. Didn't start out that way. So yeah, Dave Seymour, Flipping Boston. I'm now one of three owners in a company called Freedom Venture Investments. We're a fund company. We manage $100 million fund that's investing in multifamily real estate. And it's been a heck of a journey, brother. That's for sure. Wasn't always dealing in the big sandbox. I used to play in a different one.
Sure. Well, it's always interesting. Let's start with Flipping Boston. Like,
Sure.
It's always a curiosity to me regarding and you seem to be a fella that would give it to us straight here. Like, how much of that is real versus? Am I going there pretty deep already?
Wow, that's a heck of a setup right there. You seem like a guy who's going to give it to us pretty real. See what I'm saying? That's what we call a lead-in. That's a leading question, Your Honor.
I know.
Nobody's going to listen to this, right? So I can tell you the truth. Look, that's a great question, Jack. And I get that all the time, okay? Can we all use some common sense and some intelligence, right? It's called a reality TV, and the last word is show.
Right.
And a show is designed to entertain. And if it doesn't entertain, nobody's going to watch it, right?
Yeah.
So look, what was real? Yeah, the houses that you saw on our show were acquisitions that we had either purchased or were purchasing and doing some kind of repairs, sometimes to sell back out into the marketplace. But the drama, maybe you could bend reality just a little bit on the drama.
Sure.
All right. So come on, let's be honest. What are the odds that every single time something went sideways or went crappy, there'd be a camera there? If you've got any experience in real estate redevelopment, you know that, something can go wrong at 3 o'clock in the morning when nobody's there. But, the first few episodes of Flipping Boston were tight, man. They were what you saw. Look, in New England, we got challenges with the age of our stock. The oldest house I ever worked on was like 1812.
Mm-hmm.
So we got some challenges with the sticks and bricks, brother. But look, I'll leave it with this. A&E Network saw a sizzle reel that our production company had put together, and at the end of the notes that were given to the production company, their notes were, that big English guy, because I'm originally from London, England, that big English guy looks like he could get really angry. We'd like to see more of that. So now you read between the lines, right? And we can all be grown-ups. You know what's interesting, though, if I can add to it, I'm a builder-upper, not a tearer-downer, but to add some real truth to it, if you look at some of the house flipping shows today, they're really kind of, I don't know, man. They're a little offensive to me. Just because you put a stain on a wall and put some trash in the corner of a room and you call it the stink house, it doesn't mean it was a real flip. You know what I'm saying?
Yeah.
So, we in New England, we really, we ripped up our houses to put them back out for sure. But we had fun, man. It put me in a national spotlight that I never believed was going to be a part of my journey. So I've been blessed and cursed.
So did you find the rehab numbers and the final sale price, all of that was pretty legit?
Yeah, my ex-partner Peter was a stickler for details, and and so he should have been. The purchase price, the construction costs, the liquidation price minus carrying costs, commissions, et cetera, that showed a true profit on the properties. if you've ever flipped a house, it's like, I bought it for 200, I put 50 into it, I sold it for 300, I made $50,000. No, you didn't, you donkey. You made, $32,372.28. You know
Right,
what I mean?
right,
So, uh, numbers for us were based in reality. Absolutely. Yeah.
sure,
And not all, they don't have to be. It's not an offering. You know what I mean?
hmm,
It's not an investment offering. It's a TV show. So,
sure. Did you find
yeah.
that you were ever directed, like in the materials and stuff you use, like because of sponsorships?
Oh, wow. You're going right after it, Jack, my man. Yeah. So watch. Okay, boys and girls, ladies and gentlemen, drum roll, please. The Wizard of Oz is about to pull back the curtain. If you watch an episode of Flipping Boston and they portrayed me as the construction guy, which I was a firefighter and I ran a small construction company for almost 16 years. So I was definitely the blue collar guy in the white collar world. But if you watch an episode of the show and you see me installing a hardwood floor, and I say, I love Mullican hardwood floors, 3/4 inch solid oak with stain resistant, mold resistant. How do you do blah, blah, blah? Come on, people. It's a commercial. So, we were given materials into the episode. But again, my partner, Pete, he deducted the cost of those materials
Oh,
from our
okay.
numbers at the end of the show because he never ever wanted somebody coming back and going,
Hmm.
So, numbers wise, cost wise, materials wise, 100%. Drama wise, maybe we bended reality a little bit.
So, okay, I'll let you off the hook now. I won't ask
Oh
you
my
anymore.
Lord. I feel like I should be wearing a lie detector, one of those straps around my chest and that little thing on my finger. Oh, I'm
Well, now you're
sorry. It's
making me
hot.
feel
It's hot
guilty
right
that I
now.
went there. So,
No, man, it's all good. It's all
no.
good. Look, if you see the host of a show walking through a door, walking towards you, and you see the look on their face, and then the next camera angle is behind the host, but you can't see what he or she was looking at. Come on, people. Come on now. There was a camera in the front and a camera in the back, and you didn't see the camera on either shot. It might have been shot once to get the drama involved. I'm just saying there's a possibility.
Right, right. So, well, let's change the subject a little bit. We'll get you off the hook. Um,
Sure.
so let's just talk a little bit about the current market conditions,
Mm, mm,
and frankly, I think we're in a situation where people are looking for alternatives. Instead of the active flipping and a few
sure.
other things right now.
Yeah.
Which
Yeah.
leads to what you're doing today. So what do you think of the current market? How are you doing regarding your multifamily investing? And
Yeah, no, it's those are fantastic questions. Look, I've been a house flipper, I've been a private lender, a hard money lender. I've been in this industry every day, all day for 12 years now. So I've been through a recession. I've been through 2008, 9, 10, 11. And a lot of people say, we're going to be facing something like that again because of the horrific slap that we took with COVID, right?
Mhm.
So what really happened with COVID is first of all, it's critically important. The fundamental impact, I believe, and this is just my opinion, and you can get opinions anywhere. I think about real estate as a service that we end up giving to people, right? We're really in the people business, but our asset is sticks and bricks, whether it's multifamily or single. How are the people doing that we serve? And I don't think anybody can argue the fact that we're in a time of fear and uncertainty. And when people are driven by the emotion of fear and uncertainty, a lot of what I consider to be common sense seems to diminish a little bit, right?
Mhm.
Now, what I mean by that is I'll give you a classic example. Wall Street would buy on the secondary and tertiary markets would buy what's called non-QM loans or mortgages. So as a hard money lender, you would write a mortgage to a house flipper, and that mortgage, that note, we would immediately sell it to Wall Street. Well, as soon as COVID hit, fear became the underlying emotion, the driver, and Wall Street shut down QM lending, non-QM lending. Wall Street said, we're not buying any more mortgages. Without exaggeration, Jack, about 75% of the hard money lenders pre-COVID are now out of business because their whole business model was based on Wall Street buying up. So now you've got a shrinking down of capital available to house flippers. Well, what does that mean? It means that the tight, skinny deals are gone. Nobody's lending on them. They're looking for a higher loan to value. They're looking for good credit scores. They're looking for interest reserves so that a borrower has got maybe 6 months or 4 months of interest payments that they can make. So it dramatically changed the landscape of hard money lending. Well, then somebody might say, well, that's only one lending source. What about private lenders? Well, what happened to private lenders? Private lenders look at the stock market and the challenges that have gone on there. And they say to themselves, well, I stay in this thing, you know, I got 20 years to retire, or I've got 5 years or 10 years. They really needed to step back and take a look at their investment strategies for their retirement, which is really what most people are investing for, right? Retirement and then generational wealth afterwards. Can I take care of my kids and my grandkids and my grandkids' grandkids, right? Can I create legacy, for want of a better term? So everybody's asking a lot of questions. And while people are asking a lot of questions, it's almost like the deer in the headlights thing, Jack. A lot of people have done nothing. And you'll hear it from all the pundits on TV. They'll all say, no, hold, don't do anything. Let's just wait. Let's just see, hold on. Well, my own take on the nation, if you will, or look at the landscape, yeah, I haven't done anything. I have not moved one dime into any investment in the past 2 months, we'll say. That's not true. I made one distribution on a construction loan, but I've really not gone out investing. But I haven't personally done nothing. What I've done is I've looked at the landscape and pivoted. And the hard money lending business that I was involved with, when that crashed in pretty much 3 days because of what I just described to you with Wall Street being the support for it, I stepped back and I said, well, what was the challenge there? And the challenge was controlling the capital. So here's what I see, and I know it's kind of a long way round, and I appreciate you indulging me on it, Jack, but I think it's important to understand the context before you deliver the content, right? The context is a nation that's riddled with fear. Financially, also, you know, socially, we've gone through horrendous upheavals. And that creates a wave of emotion within our foundation as well. So you got the underlying fear. Well, now it comes down to, well, people still need to retire. People still need to have some safety and security. So for me, it was looking back and saying, I don't want to not be in control of capital anymore. I want to be in control of the capital to make the investments. So what we did was we started looking at the statistics. What are human beings now doing? Well, COVID has scared people about large city living. COVID has scared people around being in groups. We see it in Florida right now. No, it's nothing. And then all of a sudden it's something, as we see these changes. So what we identified as a group was, myself and my two partners, was the institutional capital is now trying to go towards multifamily and commercial investing, but they only want 250 units or 500 unit apartment complexes, the larger assets. Well, I don't want to compete with those, and neither do the investors who invest in our fund. So what we do is we look at the secondary and tertiary markets close to the metropolitan areas, but we focus on like 40 to 120 unit apartment complexes, because what we see is we see an opportunity to lease up open space as people are moving, because when people move, stuff happens, man. It's just fact, right? So you've got an influx into the Florida market where we are in the Gulf Coast region. You've got an influx of population. You've got a low inventory of real estate, and you've got a high demand of people who just want out. They're migrating away from the larger cities. So that creates opportunity. It creates an opportunity for us to raise this capital, buy these smaller multifamily asset classes, and be of service at the same time. So who are you serving? To wrap it all up for you, Jack, who are you serving? We serve our investors because we give them a higher rate of return targeted than most other investments in the marketplace. And then at the same time, you service your client, which is the tenancy that lives in the assets that you manage. So, it's a very interesting time. It's not a time to do nothing, but it's absolutely a time to educate yourself and then put a plan of action in place. Because that's what we do, Jack, as entrepreneurs, man. We sit back, we survey, and then we go again, right?
Sure.
I was listening to a conversation recently, high level guys, I can't remember, Blackstone maybe. And one of the guys was saying, everybody's got a really good plan. I think it was a Mike Tyson quote. Everybody's got a really great plan until you get smacked in the mouth, and that's what COVID did. It smacked us all in the mouth. Some people have gone down and won't get up again. And then, I align myself with the people who go down and then come back twice as strong. So that was kind of long-winded, man. But, I think you get a sense of where I'm at with it.
Yeah, so it's kind of interesting that you're talking about these smaller multifamily class properties. How do you select those markets that you're finding these places in? And I'm sure
Great
that there's
question. There's a lot of
criteria.
data, Jack. It's a lot of data. It's data driven. It's driven by population. It's driven by single family cost of housing. It's driven by rents. It's driven by population close to the metropolitan areas. There's a formula. It's a proprietary formula, pretty much, that has been created by my partner, a gentleman by the name of Walter Nowicki. Walter is in Fort Myers, Florida. He's been in that marketplace, building and investing and identifying these assets for probably 10 plus years now. He's raised over $120 million of private capital to do these kinds of properties. Myself, using that proprietary formula, one of the magical things about the TV show was national exposure. So with my national network, if the right deal comes in from Indiana, for example, Indy is a great marketplace. I got guys on the ground in India looking for assets for me right now. Well, that's great, but you still got to manage and execute on your business plan, even if you take down the asset. I'm very blessed that I've also got relationships pretty much nationwide that can execute a business plan for us. So we primarily focus there, but we also focus, based off of my network and my relationships when the right deal comes down.
Sure. So is there a certain class of property that you're looking for too? Like Indy is a good example. I mean, the conditions have to be all over the place.
Yeah. We've got it. I'll pull it up. As soon as you ask me, I'll pull it right up. I've been living with what we call my buy box for the past month and a half. So on properties, B class properties is what we focus on. So in the commercial world, for your newer investors, you have A, B, C, and D class properties, A, B, C, and D class neighborhoods, right? Just like, you're graded in school, an A was good and an F was, I got one F, maybe two in my whole career, right? So they're just classified A, B, C, and D. And then they're built around determined by their year of being built. How old are they? So we focus on B class properties, B class neighborhoods, 1990s construction, and then our business model focuses on what we call a light value add. Like, I don't need to rip something down and build it up. Maybe we go through with what's called a CapEx raise or a capital expenditure raise. We put that capital into the asset, raise the quality of the asset, raise the quality of the income, and then we sell. We sell on a 6-year exit strategy, and that includes the 1 year of ramp up that we do as we're stabilizing the asset and bringing it up to our standards.
So are you looking more for possibly just when we say distressed property, you're more looking at it's just maybe under rented, not performing to its potential. We run into old, live-in landlords or something that they just kind of become a little blind to what the market rents could possibly be and that type of thing.
Yeah, you're talking about what we call the mom and pops, right?
Yeah.
So it's very common in our country for that smaller asset class, like I said, the 40 to maybe the 120 range. it's very common that they're managed by, a family, if you will. If you're like a little inside scoop on marketing, look for properties that are owned by individuals, not by corporations in this asset class.
Mm-hmm.
If somebody's managing or has an asset in their own name, they're classed as an amateur. It's just fact. The professionals understand asset protection, et cetera, et cetera. So if I identify that mom and pop organization, I identify somebody who's probably hurting right now. They're probably in a tight, if not negative, cash flow scenario, because a lot of these organizations have managed their properties on a very thin line, on a very, very thin margin. Their quality of tenant may not be, and I don't mean quality of people, don't take it on a moral thing, but the quality of tenant, their ability to pay on time every time, treat the asset well, might be challenged because, like you said, it's what they do every day, right?
Mm-hmm.
They give a discounted rent to Charlie in 4B because Charlie in 4B picks up the trash once a week. That kind of thing. That's losing potential income. And as soon as you downside your NOI, your net operating income, you're downing the value of the asset.
Mm-hmm.
Commercial real estate is based on how much capital does it bring in. So those are fantastic opportunities for us, and we identify those properties through broker relationships, through our marketing relationships, asset management companies. They know what we want, and they're always looking for us to be able to take these assets down. So yeah, badly managed, anything with a 47% or more in management expenditure, right? Income and expenses. If their expenses are 47% or higher, that's a fantastic opportunity for us because we can dial those expenses down. And every dollar that we increase NOI, we increase value of the asset. And every dollar we decrease expenses, we increase the value of the asset.
Sure.
In Boston, Jack, you'll love it. We call it a twofer. You get two for one, two for the price of one. So yeah, we're always looking for the twofer.
Twofer. So, could you talk a little bit about some properties? When we're talking about A, B, C, D, type properties, do you come across properties that are like in a B neighborhood but are a C class that you can try to pull into the B class, or how much more work and effort is a C property in a C neighborhood versus a B property in a B neighborhood?
Yeah, there's there's a lot of different philosophies on all of that stuff, and they're all right. There's an investor out there who's been investing in D neighborhoods their whole career, and they've made a very nice living in doing so, and that's their business DNA. Then there are some investors that look at C plus neighborhoods and say, no, I don't even want to be there. I want to be in that quality of a B neighborhood. I think the biggest mistake that some investors can make is that they buy an asset, and they buy the asset with the intent of raising rent above market value.
Mm-hmm.
Now, if your business model is to be at the front of the line, to be the most expensive asset out there in the sense of income, if it's almost like taking the mistake of over rehabbing a single family house.
Mm-hmm.
When now put that on a multiplier of 100 units, if you over rehab 100 units thinking you're going to get higher rents, you're setting yourself up for a challenge and potentially a disaster, not only for that particular asset, but also for your investors. So what we'll do is we'll identify a C-type property in a B-type neighborhood. And Jack, to be frank with you, it's really not a huge concern on the amount of work it takes, because I make my money and my investors make money with us because I make my money on the buy side.
Mm-hmm.
You understand what I'm saying? If it's bought wrong in the first place, Jack, forget it. You're already behind the 8 ball. So if my cost of construction, my CapEx, is a real number, well, that goes on my analysis sheet. We use a proprietary underwriting software. I put that on my analysis sheet, and then it tells me, hey, okay, that's your CapEx. That's your market rents. There's your T12, trailing 12 years income. There's your deficiencies in unit lease up. There's your deficiencies in financial collection. Bum, 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 bum. This is what you can pay for the property and still pay your investors their preferred rate of return. See, for us, it's about paying investors as quickly as you possibly can.
Mm-hmm.
Everybody, especially in COVID, is concerned about cash flow. People lost their jobs. Even some of the investors that I talked to, you mentioned a doctor prior to the call. A lot of the medical professionals tell me frequently, hey, I couldn't even open my practice, or all of those procedures that went on during COVID
Mm-hmm.
that couldn't be performed. Well, every time a doctor performs a procedure, that's how they make income, right?
Right.
There's a lot of that fear around cash flow. So investing with us and our business model is always focused on cash flow to make sure the deals make sense. So you make the money on the buy side, you realize the bigger profit at the time of liquidation when you sell these assets out.
So when somebody is evaluating a multifamily for the first time, are there like some gotchas or some numbers that they probably should particularly pay attention to?
Yeah, absolutely. There are. I did a short video on the back end of our website at Freedom Venture, and it's a short one, 7 minutes. It's worth a look. I don't even know how it all works, to tell you the truth, Jack. It connects to YouTube somehow, but um,
And I
there
can
are
link to
three
that video
numbers.
too. So
What's that?
I'll link to that video as well.
Yeah, I'll give you a link to it. Yeah. There are three numbers that we focus on, and a newer investor should focus on these as well. And it's pretty simple. It's a cash on cash return, right? Does the
Mm-hmm.
investment make sense? There's then what we call a cap rate, or a capitalization rate.
Mm-hmm.
Commercial real estate is traded on cap rates, and every market in the United States of America has a different acceptable benchmark for a cap rate for a
Right.
specific asset class. If you bought a 20 unit beautiful brick building on the Charles River, where I am up in Boston, it would probably trade right now at a 3.5, maybe a four cap, or a 4% return. That's
Mm-hmm.
the way that they're structured. But that same brick 20 unit building in Greenville, right, in the Carolinas, might trade at a 7 cap.
Mm-hmm.
Okay, but you would pay less money for the asset and get a higher rate of return, whereas other investors will look in the depressed markets, the depressed cap markets, and they'll say, okay, that 20 unit building is, I don't know, $5 million, but I'm okay getting a 4% return on $5 million, and then try and create some value in it. So
Mm-hmm.
lower cap rates are not designed for cash flow. They're designed for appreciation over time. Higher cap rates are designed to give a better monthly cash flow. So we look at cash on cash return, capitalization rates, and then the other number, which is critical for any investor in analysis, is what's called the DCR, or the DSR. Some people call it the debt coverage service ratio, or the debt service ratio.
Mm-hmm.
And that's does this building create enough income that a bank will lend on it? All right, unless an investor or a fund like us wants to just put all of the capital down and leave it there, which doesn't, that's leverage, man. That's real estate investing one-on-one, leverage somebody else's money all the time.
Mm-hmm.
So what we do is we put our capital down, and then we leverage out with the bank, 80-20, 70-30, depending on the deal. But that bank wants to know that the building can pay for itself. So the kind of like the industry standard is what's called a 1.25 DCR, or debt service ratio, debt coverage ratio. And basically what that 1.25 means is this, Jack, is for every $1 that I have to make in debt service or mortgage payment on an annual basis, the
Mm-hmm.
bank wants to see an additional 25 cents coming in.
Right.
I've seen some shifting recently. There's some institutions that are going a little the other way. They're looking for like a 1.3, depending on the asset and its occupancy, that kind of thing. So cap rates, I love to see cap rates 8% or better, because that puts me in a position where there's debt service. I can create equity as well as make monthly payments. So I like that for a cap rate number. Debt service coverage ratios always got to be better than a 1.25. and then cash on cash, just to give you an idea of our fund. And these are targeted, right? We're always being SEC compliant, but our targeted cash on cash returns are around 8 to 10%. And then our IRR, or our internal rate of return, we target that out anywhere between 18 to 20% for the life cycle of the capital working in our fund. So yes, simple numbers in the beginning, but to be very, we got to be direct here. It's not fifth grade math because after that you get into how did you get all of those numbers in the first place, and that's your due diligence and your underwriting and your expertise.
Sure. So you mentioned, you're going into a bunch of these different markets. How are you selecting and finding those and vetting out those property managers in all of these markets?
No, great questions as well. So we have just like we underwrite a property, we underwrite property managers. We're blessed to have some national managers on our team as well. It's very boots on the ground, man. It's boots on the ground. It's evaluating a property manager's business model, because it's easy to say, yeah, I managed 500 units or 1,000 units, a property management company, but it's a different thing to say I manage them professionally. A lot of these assets, they try and sell them with property management in place, and yet it was the property managers that drove down the value of the asset in the first place.
Right.
So depending on what it looks like, how they meet our criteria, there's an interview, and I mean, our process for qualifying property managers is probably a manual that thick in and of itself, right? And I'd be going through those details, for the next 3 days. But the best way to describe it is this: out of every, we'll say, 100 properties that we evaluate, we also evaluate the property managers attached to those properties, right?
Right.
So out of 100 that we evaluate, maybe 10 of them get through the initial evaluation. And out of that 10, 5 might go to the next level. And out of that 5, we might only put letters of intent and start talking contracts with the property managers on 2 of them, which is why a fund and syndicated deals can be a strategy for what's called an accredited investor, because it is time intensive. We're not talking about a couple of bucks. I mean, we're talking about $100 million. So if you're making a commitment in that kind of a world, then you better have a proven track record of success as a fund to be able to execute on the business plan. Look, man, there's good and bad in every market, and it's experience that allows you to determine what is good and what isn't. And I'll go 0 degrees on that one all day long.
We've toyed around and played around with investing out of market.
Sure.
And it's hard enough to find a property manager local where you can get your interests aligned. Your interests just naturally aren't aligned with a lot of property managers. So it's always interesting.
No, I get it. Yeah. Look, here's the bottom line. It's economies of scale. All right. So I've got the economies of scale on my side of the equation, whereas most investors are very familiar with either a syndicated deal, one sponsor, 20, 30, 40, 50 people putting in maybe 25 grand, right, on the low end. Well, that's one deal. Well, that one deal doesn't absorb the economies of scale with a fund with $100 million in it. Do things go sideways? Yeah. I'd be absolutely lying to you if I told you everything was perfect 24/7. That's what we do as fund managers. We understand the challenges before we even go in, and then we hedge against all of the challenges that we know we're going to find when we get in there. Have some property managers been fired after 60 days? Yeah. Right? Have some property managers stayed with us with longevity? Yeah. You see what I'm saying?
Yep.
So instead of all the eggs in one basket, a fund is giving us the economies of scale when it comes to those challenges, Jack.
Sure. So when you find that perfect property manager, I'm sure that not only are they helping you with any kind of vacancy rate, but they help you keep some expenses under control. Like, are there some now that you've done quite a few of these, I mean, your portfolio is rather large. Are there some like target expenses you just know, like we gotta check and get these under control right away? Like
Yeah, yeah.
pretty
Look,
common.
every market has a price per square foot, right? In construction costs,
Mm-hmm.
cost of materials are cost of materials. If we're doing them on volume, there's there's a chance to save capital on the cost of materials, but it's human beings at the end of the day. I always use the analogy of kind of like Warren Buffett. You know, he buys businesses, he looks for underperforming businesses, he goes in, he cuts the fat, makes the business more valuable, keeps it, sells it. Well, we do the same thing. Like we target payroll, for example. What is everybody getting paid for? You know, what are they really doing? And we'll either work that relationship with the property managers, or we just work it from a higher foot view, because we have industry standards that have repetitively given us the results that we're looking for.
Mm-hmm.
And to sum it all up real easy is 47%. 40% of expense to income ratio. Anything higher than that is an opportunity for us. You know, some assets we can run leaner than others. It all depends on the size and the amount of challenges that specific asset has. But with experience, it doesn't take too long to pin down where the challenges are, right?
Mm-hmm.
That overpriced HVAC contractor. You talk to the property manager and you say, why is that HVAC contractor at that price point? Oh, it's my brother-in-law. Oh, okay. You know what I mean? So
Mm-hmm.
who's asking all those questions? Well, that's what
Right.
we do as fund managers, right? We delve into all of those specific details. And look, man, I'd love to be able to put it all in a nice straight line, but it's hard to talk about a combined 50 plus years of experience with us as fund managers on this stuff. Like we look at it at expense income ratio, and without even talking to my partner, Walter, we already know where the challenges are and whether we can fix them or not. And some you
Sure.
can't fix, so we don't buy them.
Mm-hmm.
It's as simple as that.
Right. No, so it sounds like you really rely pretty heavily on your network, and I think that's a pretty solid point to pull out. I mean,
Mm.
in your network is everything, and if you seem to be in a situation where if you're moving into a market, one of your first tasks is building out your network in that market.
Sure.
Would that be
Sure.
safe to say?
Yeah, no, you're absolutely right. There was a saying, corny, not corny, put it any way you want. I don't care. Your net worth is a correlation of your network, right?
Mm-hmm.
Which is, this is so hard to do sometimes, man. I'll go direct with you again. I always talk about the guy from the TV show as somebody else. Otherwise,
Mm-hmm.
it feels like an ego trip, right? But what separates us and our fund is that guy from the TV show, in
Mm-hmm.
the sense of he is able to open up doors and get responses that a lot of other people can't, right?
Right.
There's an old adage in business, right? If your phone goes off and you see on the caller ID and you send that person to voicemail, you don't ever want to be that person going to voicemail. You understand?
Mm-hmm.
So to be able to go into a market that we identify as having upside potential for us to put our investor capital to work, it doesn't take me very long to make 5-10 phone calls and have the top 2, 3, 4 players in any specific service that we need at the end of the Rolodex, showing my age, on the phone, to be
Mm-hmm.
able to get some numbers rolling and get some feedback. I don't care whether it's a broker, I don't care whether it's capital, it's property managers. Building a team in that market is less of a challenge for us. So it is network driven, brother. It really is. It's it's not what you know, it's who you know. But
Mm-hmm.
if you don't know what you know, you're never going to get the right people to be in the who you know department.
Right.
That makes sense. Yeah, makes sense to me.
So with that, I know I interrogated you for quite a while here.
That's all right,
But
man. I love it.
before I we end here, was there anything that you wish I would have asked?
No, man. I'm I'm one of those guys who does everything he can to be in the moment, and whatever we discussed is what we were supposed to discuss.
Mm-hmm.
You know what I'm saying?
Yeah.
Like,
No.
I'm not a guy of organized religion, but I'm definitely a man of faith. And if we had a message today that helped just one person who listened to the show, then that's what we were supposed to do today. You know what I mean?
Yeah.
There's not an ulterior motive. If somebody reaches out and we put capital to work and give them a great rate of return, that's awesome. If somebody doesn't reach out, that's okay too. We're going to be fine. You know what I mean?
Yeah.
Let me ask you a question. Is there anything I can do for you, Jack?
I just appreciate your background and growing my network.
There you go, brother. There you
So
go. There it is. And
so
if you're new to the business, don't give up. Just stay the course. I
yeah,
was broke as a
exactly.
joke one day, and 12 years later, I'm in such a different world, and I'm blessed.
Right. So if people were interested in more information or getting in touch with you, how would they reach out?
Yeah, there's a couple of different ways. You can just search us out on Facebook. Go figure. You can find me at Dave Seymour Live. That's my personal page.
Mm-hmm.
Our company is Freedom Venture Investments. You can find us at freedomventure.com is a
Sure.
website. It's probably your most direct. And if you do go to freedomventure.com, if you scroll down to the bottom of the page, there's a book that I just finished with my property manager, of all people, a gentleman by the name of John Dessauer. John and I just finished an ebook. It's a free download. You're more than welcome to grab that. Unlocking the code to multifamily investing.
Mm-hmm.
And there's great resources there. Reach out, spend a little time with us, or don't. But it's all about network, man. But you can grab a hold of us at either one of those places. Freedomventure.com. You can find me, Dave Seymour. Just Google me, Dave Seymour, Seymour. Find me on LinkedIn, I guess.
Yeah.
It's not my
LinkedIn is
realm.
one of those things I think people kind of forget about, but frankly, that's probably my biggest network.
Yeah, Gary Vaynerchuk, if you know who Gary V is.
Yep, I
Gary
do.
V, he was part of a mastermind group that I was with or affiliated with years ago. And anyway, Gary V said in 2013, I think it was, just did a post today. He was talking up LinkedIn back then, and now whatever amount of years it is later, 7 years later. Yeah, 7. Yeah,
Mm-hmm.
no, 13. I don't know. Whatever. Can't do the math. That's a formula.
Mm-hmm.
The next one he was talking about was this TikTok thing, but
Yeah.
my network's for accredited investors, so I don't know if they're hanging out on TikTok yet.
Yeah. Some of the, as much as I want to keep up with Gary V, he jumps on these platforms really fast.
Yeah, yeah,
TikTok,
yeah.
maybe it's just my age. I don't quite get it.
Yeah, I got a little gray on the side. You got a little gray in your beard, brother. I get it. I'm with you. It's all good.
My
So yeah,
daughter's
that's where
been
you can
trying to
find
get me
us.
on Snapchat. I have it installed, but I don't quite get that either. But
I haven't even got Pinterest figured out, so don't worry about it. Us old guys will hang out together. It's all good.
there you go. So thank you so much for joining me today, Dave. And I'll make sure to include all those links in the show notes.
Yeah.
And I hope we can do it again sometime.
Yeah, you bet, brother. I'll send you a little, all the links that I have. I'll send it to you, and then you can throw it on there if you'd like. Okay?
Yeah, sounds great. Appreciate it.
All right,
Thank you,
brother. Be
sir.
well. Take
Yeah,
care,
you
man.
too.
Bye.